For decades, the US dollar has sat at the center of the global financial system. But what would happen if countries around the world slowly stopped depending on it? Welcome to this investigative documentary. Today we're diving into a realistic, highly debated hypothetical scenario that's honestly on the minds of central bankers and economists all over the world right now. We're going to explore the historical foundations of the dollar, why some nations are actively trying to sidestep it today, and what a fractured, multipolar monetary system would actually mean for the global economy.
Section 1. The Rise of Dollar Hegemony.
Okay, let's dive into this by tracing the history of how the US dollar became the undisputed king of global finance. You see, the supremacy of the dollar didn't just happen by accident, and it's not simply because the United States has a massive economy. It's actually the result of a very specific sequence of historical events that structurally locked the global financial system into a dollar-dependent architecture. It really kicks off in 1944. As World War II was wrapping up, Allied nations gathered at Bretton Woods and agreed to a totally new financial order. They pegged their national currencies to the US dollar, which, in turn, was pegged to gold. And because the US was the dominant industrial power left intact after the war, well, this system made perfect sense. But fast forward to the 1960s, and things get shaky. Mounting US economic challenges, rising inflation, and heavy Vietnam War spending really strained that gold standard. So in 1971, President Richard Nixon made the historic decision to unilaterally end the dollar's convertibility into gold, an event famously known as the Nixon shock. Suddenly, the dollar became a pure fiat currency. But instead of collapsing, it found a brand new anchor, the petrodollar system. In the 1970s, the US and Saudi Arabia struck this monumental agreement where oil would be priced exclusively in US dollars. And just like that, almost overnight, every nation on Earth needed to hold dollars just to keep their economies running.
Section 2. The dollar's exorbitant privilege.
Now, this historical foundation is exactly what gives the United States massive, honestly entirely unique economic advantages today. Because the rest of the world is structurally forced to use its currency, the US basically operates under a totally different set of financial rules than any other country on the planet. Back in the 1960s, French Finance Minister Valéry Giscard d'Estaing actually coined a pretty perfect phrase for this, the exorbitant privilege. Think about it. Because global demand for US dollars, and by extension US Treasury securities, is practically bottomless, the United States can run incredibly high debt levels and finance its deficits really cheaply. When other nations go into debt, they usually have to borrow in a foreign currency, which exposes them to massive exchange rate risks. The US, on the other hand, well, it gets to borrow in the exact same currency it prints.
Now, what's really interesting about this slide is the sheer scale of this dominance. It's honestly staggering. According to the latest data from the IMF and the Bank for International Settlements, the dollar absolutely dominates three massive roles in the global system. First, as a means of payment. It's involved in an astonishing 88% of all foreign exchange transactions and around 40% of global trade. Second, as a unit of account. Global commodities and a huge chunk of international corporate debt are all priced in dollars. And third, as a store of value. Currently, it makes up 57.8% of global central bank reserves. These are massive, deeply entrenched network effects. Governments hold dollars simply because other governments use dollars, and banks lend in dollars because borrowers expect to repay in dollars. It's a self-reinforcing loop.
However, this privilege comes with a pretty massive built-in trap. It's known as the Triffin dilemma. The economist Robert Triffin pointed out years ago that for the world to have enough dollars to actually conduct global trade, the United States has to constantly pump dollars into the international system. And how do they do that? Usually by running continuous trade deficits. So the US essentially has to accumulate massive debt just to supply the world with liquidity. The dilemma here is that as this debt mountain grows higher and higher, global investors inevitably start to look at it and question the long-term value and stability of the currency itself.
Section 3. The drive for de-dollarization.
And this brilliantly illustrates where we are today. We're starting to see some tangible cracks in that foundation. We are witnessing a concerted effort by several nations, most notably China, Russia, and the broader BRICS economic bloc, to actively explore ways to insulate themselves and reduce their dependence on the US dollar. A major catalyst for this shift is the growing perception that the dollar has been weaponized. Following recent geopolitical conflicts, the United States and its allies froze roughly $300 billion in Russian foreign exchange reserves. For a lot of countries, especially in the global south, this was a massive wake-up call. It vividly demonstrated the profound political risks of relying entirely on the dollar. Finance ministries all over the world looked at that unprecedented freeze and naturally asked themselves, wait, if this can happen to them, could it happen to us?
If you enjoy documentaries that uncover the forces shaping the world economy, subscribe to Golden Fern. We investigate the stories behind money, power, geopolitics, and history, beyond the headlines.
So the crucial point is that the threat to the dollar isn't just some abstract theory being debated in academia. It's a very tangible concern among global financial professionals right now. A recent CFA Institute global survey mapped out exactly what the markets view as the biggest threats to the dollar's reserve status. When you look at the breakdown, 30% of respondents cite concerns over the U.S. government's ability to continue servicing its massive debt, while 28% point directly to geopolitical tensions reducing the number of countries willing to use the currency.
But when you actually split that data up geographically, a really striking divide emerges. In emerging markets, the number one fear is geopolitics and sanctions, which was cited by 36% of respondents. They're deeply worried about financial exclusion. In developed markets, however, the primary concern flips. There, it's all about the U.S. debt mountain, with 31% fearing that the sheer mathematics of America's deficit spending will eventually erode the dollar's value over time.
Section 4. Rise of alternative currencies.
With all these fears mounting, we're naturally seeing the rise of challengers. From regional payment systems to digital currencies, alternatives are being heavily researched and tested right now. However, as we'll see, pulling off an outright replacement of the US dollar is incredibly difficult in reality. Let's impartially compare the leading alternatives. The euro is probably the closest competitor, but it lacks a unified fiscal policy. It represents a zone that's still pretty politically and economically fragmented. Then there's the Chinese yuan, which is absolutely growing in bilateral trade, but China maintains strict capital controls. That basically prevents the free flow of money you'd require for a true global reserve currency. Gold is seeing record central bank purchases lately, but it lacks the digital liquidity and the sheer scale needed to handle modern daily international trade. And what about a proposed BRICS currency or even cryptocurrencies? While academic research consistently highlights massive scalability and coordination issues there, a currency union requires member states to strictly align their economic policies, which is deeply, deeply challenging for nations that have vastly different economic engines and geopolitical goals.
Section 5. What happens if it falls?
Let's move to and see how this builds, because knowing the challenges of replacing the dollar, we still have to ask, what if it actually happens? What's the realistic hypothetical scenario for the global economy, and specifically for the United States, if global demand for the dollar were to significantly decline? Let's trace the domino effect step by step. First, de-dollarization means a reduced foreign demand for U.S. treasuries. If central banks around the world aren't buying U.S. debt to hold as reserves, the U.S. government has to offer drastically higher interest rates just to attract buyers. And that leads directly to step 2, spiking borrowing costs for the U.S. government, corporations, and everyday consumers. Step 3, as the U.S. loses that exorbitant privilege to export its inflation, domestic inflation could rise significantly, which would likely lower the American standard of living. And finally, step 4, we would see major upheavals in international trade. Countries that are heavily dependent on dollar-based finance would face intense volatility as commodity pricing shifts away from the dollar and toward a basket of regional currencies.
Section 6. 3 futures for global money.
So when we synthesize the official data, academic research, and expert analysis from institutions like the IMF and the BIS, the consensus generally points away from some sudden catastrophic collapse and instead points toward a gradual evolution. Experts basically outline 3 possible futures for the global monetary system. First, the dollar remains dominant. This is strongly supported by the unparalleled depth of U.S. capital markets, the sheer inertia of global trade, and the simple fact that there is currently no viable, fully liquid alternative ready to take its place. Second, and a lot of experts find this increasingly likely, is a transition to a multi-currency world. We're actually already seeing the slow but undeniable rise of alternative financial plumbing like China's CIPS or the mBridge digital currency platform, which allow regional trade to completely bypass the dollar. Finally, the third scenario is a substantial loss of the dollar's global role. Now, this wouldn't happen overnight. It would likely have to be triggered by a severe U.S. debt crisis that shatters international confidence or a geopolitical fracture so deep that the world practically splits into completely isolated economic blocs.
Which brings us to the ultimate question we have to ask ourselves as the financial architecture of the world slowly shifts beneath our feet. If the dollar ever loses its position at the center of the global economy, what replaces it? And what happens to the world when there is no single dominant currency?
If you enjoyed this documentary, subscribe to Golden Fern, like the video, and tell us in the comments what global story we should investigate next. Thanks for watching, and we'll see you in the next documentary.